In this presentation, we will discuss accounting for a process cost system. This will be a long presentation, so if you would like to jump to relevant points within it, take a look at the description below, which will have links to those points, as well as a description of what will be included within them. In this presentation, we will take a look at the flow of materials, labor, and overhead within a process cost system. In other words, we're going to track the materials, labor, and overhead as they flow through from the raw materials to the finished goods within a manufacturing company that uses a process cost system as opposed to a job cost system. In comparing the two systems from a job cost system and a process cost system, we'll see many similarities and a few differences. So we want to consider those two because every time we take a look at the process cost system, we really are contrasting it to the other type of manufacturing process, which is a job cost system. Keeping in mind those differences, also keeping in mind that we might have some companies that have some component of both a job cost system or process cost system. But as we consider and learn them, we typically keep them separate in our minds so we can compare and contrast them. Both of these items will be starting with raw materials that we want to then convert to finished goods, and therefore are different than a merchandising type of company, which will just have the goods that will be purchased and then the goods that will be sold. There'll be no processing of the goods. It'll be a lot easier then to track in that format. Here, of course, we're going to have the raw materials which are not finished, convert them in some way. That conversion process is going to be in the form of, in a cost form, the overhead that we're going to apply, as well as the labor that will be applied to get to the finished goods. And then, of course, once we're at finished goods, we're at a similar point as a merchandising company, and we will, in essence, just sell the finished goods, record the cost of goods sold at the point in time that we sell. The difference with tracking the flow of a process cost system and a job cost system is that we're not tracking by job, we're tracking by process. Now, note, when you track by job, you still use the account of a work in process type of account, but that work in process type of account is supported by a job cost sheet. And in a process cost system, we still have work in process accounts, but we're not going to be supporting them with a job cost sheet because we're not tracking by job. We are instead tracking by process, by department. So we're going to track this information, this cost for the inventory, by the process that it's currently in. We think of a process cost system as being more of a linear type of process that we're going through typically. So if we're making something that goes through a process, such as making candy or something like that, it might go through a department 1 where we make the candy, department 2 where we put the candy into the wrapper or something like that and package the candy, and then it would go to finished goods. So we can see kind of a linear type of process, and that's going to be what's going to be the difference then in terms of the accounts. In other words, we might have 2 work in process accounts or more work in process accounts representing different departments, as opposed to a job cost system where we have 1 work in process, which is then supported by the job cost worksheets that will support the detail of what's going into the work in process by job. Other than that, the flow in the journal entries will look similar, but we'll have to account for, of course, these 2 departments, these 2 work in processes. We'll start off in a similar fashion as we would with a job cost system. We're going to buy the materials. So we'll buy the materials. So the materials you can track kind of like you would inventory for a merchandising company. You can have beginning materials, you're going to have purchases, and then ending materials. You can have like a similar kind of calculation for calculating what materials were used. But in essence, we're going to have beginning materials, purchases for the materials, and then we're going to transfer, we're going to credit the materials. So here's our T account, debit, debit. Now we're crediting it. This is an inventory account, and therefore it has a debit balance. If we credit it, it's going down. This is what would happen when we requisition the materials to the work in process. That would be the credit. The debit then would be to the work in process account. And we're typically considering materials, if we make something like candy with the sugar and whatnot, would typically go into department A. That's where we actually make the candy typically. So we're going to go to department A, and then we can imagine, of course, it's going to go to department A, and then it's going to go to department B, which is the packaging department. So that would be the normal process. Most of the materials are going to go to Department A and then to Department B once finished in Department A, once it's been converted from sugar to candy. But also, we're going to have materials that will go to Department B. So it's not all going to go to Department A and then to Department B. Most of it probably going to Department A, then transferring to Department B once finished. But we're going to have some materials that will go directly to Department B, such as the packaging kind of materials, like the wax paper or something like that, that we're going to need in Department B. So we will have direct materials going both to Department A and to Department B. The materials going to Department A are probably the bulk of the materials, the main thing we think about when we process something, because that's what we're using to convert, in this case candy. The materials going into Department B are probably not the main thing we consider, like the packaging type of materials that are going to go into Department B. So that if we think about that in terms of the trial balance, then of course, we've got the materials up top. It's all inventory. We've got the materials up top. It would be decreasing the materials up here and going into Department A, the work in process, and here. So we would be crediting, this is a debit balance account. It would be going down, and then we would debit the work in process accounts, and those would be increasing. It's all in the assets, no net effect in the assets. Assets would be going up, assets would be going back down when we do that transfer. This is what the journal entry would look like. This is the T account up top. This is the journal entry. The journal entry would generally be triggered with a materials requisition form. So that's the form that would generally say, hey, we need materials from the warehouse. We're imagining the materials are in some type of warehouse. It's going to be moved then to the work in process department. We can imagine all the sugar being dumped into a big bucket or something. And that's now we're in the work in process department. The journal entry then would be a debit to Department A, work in process, debit to Department B, work in process, for whatever is needed in Department A and Department B. Department A needing, in our case, sugar and whatnot. B is going to be needing the wax paper, and then we would credit the raw materials, decrease in the raw materials. So of course, again, that would mean materials is going down, and then the work in process would be going up. These two accounts would be going up. We're all talking about assets, so the assets here would be increasing with a debit. The asset here would be decreasing with a credit. So then the next step we're going to have is to be adding things into the work in process. So if we consider work in process now, we've got direct materials in there. There's three things that are going to be involved in inventory all the time. Direct materials, we have direct labor, and then we've got the overhead, all the other kind of stuff that we have. So we already have the materials in there. The next thing is the factory payroll, or the payable, or the labor that's going to go in there. When you think of labor, you got to think of kind of payroll. Payroll is happening, and it's a little bit confusing to think of payroll, because payroll we usually consider, we debit payroll expense or something like that, and we credit payroll payable or cash. And I'm not dealing with payroll taxes. We're just getting into the generals of payroll here for the process of the inventory. And here we're going to say, no, we're not going to debit the expense, because we're putting these workers are working on inventory. So we're going to debit we're basically going to capitalize their work as an asset, as opposed to expensing it in what they're working on, which is inventory that is not yet completed, and therefore in the process of work in process. We're going to credit factory payroll payable. When you see a book problem, they'll typically credit a payable account when you're working with these process cost systems, because you could think of it as crediting cash. We're paying cash, we're taking it out of the checking account, but that doesn't indicate what we're paying, and the debit's going to go into work in process. So if we say it's a payable, we're taking it out of the payable, that gives us some indication, without having to write a description with the journal entry, that we're talking about some type of payroll item that's happening. So we're going to credit the liability as if we haven't yet paid the payroll yet, instead of cash, and then we're going to debit the work in process instead of an expense for wages expense or payroll expense, because these people are working on the inventory that's not yet completed, therefore work in process. Again, most of it will probably be in Department A, because that's where most of the work is done. Also note that the labor, the conversion with labor, usually is fairly small, possibly, for a process cost system, because everything is the same. We might automate in the entire process. So there might not be a lot of labor involved in the work in process in a process type system that is more automated type of system. And then we also going to have the direct labor that's going to go into Department B, however. So remember, you're usually thinking it's going to go into Department A and then roll into Department B once it's done in Department A. But of course, we are going to have some direct labor that could be in Department B as well. So the majority of it probably in A, because that's where most of the conversion happens. And B might be less labor, but again, we're going to have to apply out the labor to A from A to B, A and B. And once A is done, of course, then we'll convert or transfer the process or the inventory from A to B as well. The journal entry will look like this. We're going to debit the work in process for Department A, the work in process Department B, and we're going to credit the factory payroll payable. Now note, again, this is kind of like, this is basically a payroll journal entry. We're not dealing with any withholdings here, however. So you could consider if this was cash, we're paying people cash, and then we're debiting the work in process instead of payroll expense because we're capitalizing it here. And so, and note, we're not dealing with anything with regard to payroll taxes or withholdings at this point. We're just making a simplified journal entry so that we could see the process or how it would look in terms of the capitalization of these items within the work in process. So work in process here would be going up here, and then the payable would be going up because we haven't yet paid the employees. Also note that we're always talking about payroll on the factory because we're talking about those workers that work in the factory. If you're talking about a book problem and it says the factory, well then it has to do with inventory. If it says something admin, then it has not to do with inventory, and you're not talking about something that would be in part of the inventory, but something that would be a period cost typically. And then of course we have the third thing that's going to happen, which is going to be the manufacturing overhead. So in our work in process, we have the direct materials, we have the direct labor, now we have the manufacturing overhead. Now the actual costs with the manufacturing overhead is anything on the factory. So anything that's included in the factory, if it's going to be a debit to the manufacturing overhead, the actual cost, depreciation on the factory, or if there's rent on the factory, or rent on the equipment, or maintenance on the equipment in the factory, all these things that we can't apply to a specific department possibly, then would go into the manufacturing overhead. And then we're going to use some type of estimate to take the money out of the manufacturing overhead and applied it to the proper department based on some type of estimate. We'll talk more about that later, but we're going to apply it out. So now we're going to be reducing the manufacturing overhead. And again, the manufacturing overhead would be increasing by what? All the stuff we couldn't apply to the department. So anything in a book problem that says factory this, factory that, and we can't apply it to Department A or Department B, we're just going to dump into manufacturing overhead, then use some type of estimate to apply it out. In terms of the journal entries, then, everything that we dumped into manufacturing overhead would typically be a debit, debiting these items for things like the utility on the factory, crediting whatever we paid for utilities or utilities payable, debiting anything that would be supervisor salary or something for both departments that we couldn't apply to the department, and crediting payroll for the indirect items in there, debiting this item for any possibly small materials that are going to both A and B, and crediting the materials for that item. So these are the types of things that would be going into the manufacturing overhead because we know they're on the factory, they're part of inventory, but they haven't been, we can't apply them to a particular department. Then we're going to apply them out. How do we do that? We do some type of estimate. So we're going to use some type of estimate and apply them out to Department A or Department B. So once that is done, then we're going to have the applied overhead. Again, most of it we might think would go to Department A depending on how our estimate works, and then the rest of it is going to go to Department B. And again, once we're done with Department A, these items are going to roll over to Department B because it's in that process. But as we go through this, note that we had part of the materials, the direct labor, and applied overhead that goes to Department A and Department B. The journal entry then, factory overhead decreasing, and it's going to be a debit to work in process Department A, work in process Department B. Here's work in process Department A, work in process Department B, and the overhead. Next item that's going to happen is now we're going to finish items in the work in process Department A. So it includes direct materials, labor, and applied overhead, the three components of inventory now in Department A. We're going to transfer it now when it's completed from Department A. So the candy's made, it's not now in the wrapper, right? So now we're going to transfer it out of Department A and we're going to put it into Department B. So we're going to credit Department A to decrease it because it's an asset account. We're going to debit Department B because now we've transferred the actual candy into Department B, which will then go into the wrapping department. Now we have work in process for Department B increasing with a debit and work in process for Department A decreasing with a credit. So remember, we're talking about assets here. So the Department A is going down. We're going to do the opposite thing to it, which is a credit. Department B is going up. So we're going to do the same thing to it as its normal balance, a debit. Next item, at some point, we're going to finish the work in process for Department B. And notice that includes now the direct materials for Department B, like the wrapper and stuff. And then we've got the direct labor for Department B, the overhead for Department B, and then the stuff that was transferred, of course, from Department A to Department B. Once the wrapping is on the candy in Department B in our example, we're going to credit Department B and we're going to move it then to finished goods. So we're going to credit the work in process, move it to finished goods, and that's going to be the calculation of the cost of goods manufactured. And that's going to be what we'll use to know the amount that we need to take out of the work in process for Department B in our example and take it into the finished goods, cost of goods manufactured. Journal entry then is going to be a debit to finished goods inventory. So now we've got the debit to finished goods inventory. That's going to increase with a debit. It's going to decrease the work in process inventory account. Now it's in finished goods, and we're in kind of a similar type of situation that we would be if we were just buying and selling inventory because we're ready to sell the inventory. Then we're going to take the information from finished goods. We're actually going to sell it. So when we sell it, then we're going to take it out of the finished goods. We're going to credit finished goods and we're going to debit the cost of goods sold. Now this is a little bit confusing because at this point in time, we spent all this time tracking the cost. And usually when we consider accounting, we're spending a lot of time focusing in on the sale. And so when we consider this transaction, this last transaction, it's hard to decouple it from the goal of the business, which is revenue generation. So the two things that happen at the same time is that this happens when we make a sale. And the sale we could think of as a separate kind of journal entry that happens at the same time, which is revenue increases, and then accounts payable increases or cash increases. At the same time, the inventory, finished goods inventory, decreases, and the cost of goods sold, the expense, increases. So if we look at the journal entry, then there's two things that really happen here. We're concentrating on this item, the cost of goods sold, the part of the journal entry that usually gets less attention to it. So when we make a sale, we're going to increase accounts receivable, increase sales. So this item and this item. The other thing that happens, of course, is the inventory goes down. Finished goods inventory in a process cost system goes down with a credit, and the debit is the cost of goods sold. So note, sales went up with a credit with the top journal entry, and then it's going to go down, or net income goes up with a credit, right? Because the income goes up with a credit, the net income goes up with a credit or an increase to income, and then the cost of goods sold increases the expense of cost of goods sold and bringing the net income back down. So the net income would go up by the sales and then down by the cost of goods sold, which of course would make sense because we're selling the item for what we can sell it for minus what it costs for us to produce it. The cost of goods sold, that's the effect on net income. In this presentation, we will discuss methods to calculate ending work in process and units completed. In a prior presentation, we went through the flow of inventory from raw materials to the finished goods inventory, and then the sale of that inventory and the expense of it in the format of cost of goods sold. As we did that, you'll note that we had these items or these times when we had to transfer from Department A, for example, to Department B in our process cost system, and from Department B to the finished goods. The journal entry to transfer from Department A to Department B would be to credit Department A and debit Department B, in essence decreasing Department A and increasing Department B. In our example, we're discussing like making candy. In that case, we would take it out of Department A once the candy is done, put that into Department B where the Department B applies the wrappers or something like that. And then we're going to take it out of Department B once the wrapper is has been given and put it into the finished goods. So then we'll have the completed product from Department B to the finished goods. We're going to need some method, however, to note how much is still in Department A and how much is still in Department B, how much is still in Department B, and how much is in the finished goods. There's two methods typically to get to that determination. Or in other words, each department, in our case Department A and Department B, have to do two numbers or have to calculate two numbers. One is going to be the cost of its ending work in process inventory, what is still in the ending work in process at the end of the time period. In the case of Department A, with us making the candy, what is still in the work in process not completed. And with regard to the packaging, what is still work in process and not completed, not moved out to ending inventory, and cost of its completed units that were transferred to the next stage of the production process. We're going to have to figure this out, and it's not the easiest thing to figure out. It's not as straightforward because the units are not totally complete. So we're going to have to determine how much is going to be still in process, how much has been transferred out in each department. In our case, we had an example of two departments, the production department and the packaging department. Note that when we think about the journal entry, we're thinking about a dollar amount, of course, because we're thinking about financial statement transactions. To get there, however, we're going to have to think about units of inventory. So we must calculate the units within each department, the units of inventory within each department. Couple methods we can use to do that. One's the weighted average method, and the other is going to be a first in, first out method. Now, you might recognize these methods as the flow of inventory or flow assumptions that we would make if we were a merchandising company purchasing and selling inventory and making some type of flow assumption. It's a similar type of assumption here, but the application of it will look a little bit different within the manufacturing process. Weighted average method. Calculated unit cost by combining costs and outputs from the current and prior periods. So in other words, we're looking at costs and outputs and in some format combining them with the current and prior periods. Makes no distinction between work done in the prior and current periods. It blends together the units and costs from the prior and current periods. So in so doing, we're going to blend them together. We're going to basically, in essence, that's going to be the averaging process, and assume the averaging process will basically work itself out. The average will work and be okay to use. The weighted average method, because of this blending process, because of us not basically making a distinct cutoff between the work in the prior period and this period, in other words, because of the blending together of units and costs from prior and current periods, is often a little bit easier, if not quite as precise, and that would be one reason to use a weighted average method versus the first in, first out method. First in, first out method calculates unit cost based only on costs and output from the current period. So we're looking at the costs for the current period and applying out those current period costs with a first in, first out assumption. Our comprehensive problem will use the first in, first out method, and our example problems and our illustrations will be using the weighted average method. In this presentation, we will take a look at equivalent units of production using the weighted average method. This will be our given data. Up top, we have the units, we have the percent completed materials, we've got the percent completed conversion. Then we have the work in process as of June 1st, which is going to be the beginning of our time period, the month in this case. Units started into production in June, the units that we then started. Units completed and transferred out of the Department A during June. So these are the units that went out. And then the work in process for June 30th. That's what's still going to be in the process. So you can see this would be our standard kind of calculation. We would say, okay, we have the beginning units of the 330, then we started another 6600, and what is still in there at the end, you can think of as basically a physical count. We could try to count basically, in essence, the units in some format that are still there, 5940, and that's going to give us the 990. Now, of course, part of our problem here is that these units aren't totally completed. So we're talking about units here, whether they be completed or not. And then we're going to be considering the portion that has been completed. We're going to use some type of estimate to determine how much has been completed or not of these units. So in this case, we're going to have to use some type of estimate to do this. So note that in practice, we would have to use some type of estimate to come up with these percentages. So if you're asking, where did you come up with these percentages? They're usually given in a book problem. In practice, of course, we would have to take the trade that we are in and then determine what an appropriate percentage for the unit completion would be used given the practice of that trade or business. So then we're going to have the computation of the units of production. We're going to have the units completed and transferred out of the department in June. And if we have, that's going to be the 5,940 for the materials. So we're talking about the materials. We're looking at that same 5,940, considering it in terms of materials and in terms of conversion, because we're considering now equivalent units, not total units, not units as if they're whole, but equivalent units with regard to their two components. Remember that there are three components we typically think about when we think about inventory. That's going to be the materials, and then the overhead, and then the labor. We here are combining together the conversion, which is the labor and the overhead, and having the materials broke out separately. There's a couple of reasons why we might be able to do that. One is that, the labor could actually be low, given the fact that we're in a production process. There might be little labor, but in any case, that's why we have two items that we're breaking out, and we're considering the level of completedness based on those two different items. And then we have work in process in June. So work in process in June at the end of the time period is 594. How did we get to that? Well, it's going to be the 990 times 0.6 or 60%, 594. And then for the conversion, 297. So we've got 990 times 0.3. That's going to be the 297. And that's going to give us the equivalent units of production in the department during June, which is going to be the 6534, which is the 5940 plus the 594, and the 6237, which is the 5940 plus the 297. Note what we are not doing in this process. We're not breaking out the beginning work in process as we would do under a first in, first out method, because we're using a weighted average method. So what we have here, once again, units completed and transferred out of the department in June. So these are the activities that were completed and transferred. Under a first in, first out method, we would assume that part of the cost of those, of course, were started in the prior time period, and we'd have to break out the current cost just for this time period. But in this case, we're kind of averaging those out. We're taking these amounts, even though part of the cost was from the prior time period, and we're kind of averaging them out. And then we're taking the work in process for June, which is the 594. So here's the 594, and we are applying out the percentages here of the 990 for the materials and the conversion. So that means this is the stuff that was transferred out. This is the stuff that's still in work in process. And if you were considering this from a first in, first out standpoint, you would think that these wouldn't be completed, at least with regard to conversion. They would still be in process, and some of the costs would be applied out later. But again, between the beginning inventory and the ending inventory, up here and down here, we're kind of averaging those out in the weighted average method. And therefore, this is a bit simplified, a bit easier of a calculation than we'll see when we do the first in, first out method, where we would have to break out the portion of the beginning inventory and the ending inventory, assuming a first in, first out flow assumption. In this presentation, we will calculate cost per equivalent unit using the weighted average method. Last time we computed equivalent units of production for materials and conversion. We're going to use this information now to apply out the actual costs. Note what we're talking about here are units as opposed to the costs. When we consider the journal entries, we want to consider dollars. We're thinking about dollars, and we therefore need to do some type of conversion between units and costs. Here's going to be our given data. So our data that is given, we're now talking about the dollar amounts. We're talking about the dollar amounts that were spent. We know what the dollar amounts are. What we don't know is how to apply those dollar amounts out between the various departments. So here's going to be our given data. Work in process at June 1st for the material costs has 6,731. For conversion, 4,312. And then costs added to production in June, the current month that we are in, so the beginning costs and what we incurred, the 130,483, and the conversion is the 89,243. So here is our calculation then. We have the work in process for June 1st. We have the materials. We're just pulling these numbers down then. The $6,731 that we're talking about now, not the units, and the conversion 4,312. That comes up with a total, if we add these two up, to 11,043. Then we have the costs that are added. Again, we're just pulling these numbers down, the 130 for 83, and we're pulling down the 89 243. Those add up to 219,724. If we then sum everything up or total this out, we've got the total cost, the 1143, the 219,726 for 237,69, and then the materials total costs for the beginning and what was added, 6,731, 1,030, 483 is the 137,214, and then the conversion, we have the beginning amount of 4,312, and then we added 89,243 for a total of 93,550. So there are our total costs that we need to now apply. We're going to have the equivalent units then, considering the equivalent units from our prior slide. So that's the 6,534. We're now getting these equivalent units from our prior slide here. So 6,534, and for conversion to 6,237. So in other words, here's our total cost broken out between the materials and conversion in dollars. Now we're going to be using these equivalent units and applying these out per equivalent units, which we will later use to apply out our costs. So we have the equivalent units. We're going to divide those out then. The cost per equivalent unit will be, with this 137,214 divided by the 6,534, gives us the $21. And then if we take so now we have our dollar amount, our cost per equivalent unit, and we can use that cost per equivalent unit as kind of an average to help us to apply out the costs to the appropriate department. In other words, we will calculate the costs for the units that were transferred out, and we'll calculate the costs for the units that are still in the work in process for a department. In this presentation, we will assign costs to units using the weighted average method. In other words, we will assign costs to the work in process at the end of the time period and the costs to the costs that were transferred out of the department. The total of those two will equal the total costs that we need to account for. So we're going to use this information to assign the costs to units to determine the amount of the cost that is still in work in process for the department and the amount that was transferred out of the department, out of the work in process. Here's what we determined in prior presentations. We computed equivalent units of production. So we have equivalent units of production with relation to materials and with relation to conversion. Notice this is in units, and now we need to assign basically the dollar amount to them. We have units completed and transferred out of the department in June, the 5940 and the 5940 for materials and conversion, and then work in process for June being the 594 and the 297, and these then giving us the total. Once again, those in units, we need to get the dollar amount applied to them now. Then we had the cost per equivalent unit, where we took the total dollar amount. We had the work in process at the beginning, dollar amount now, and then we had the costs added in the dollar amount. So these are the total dollar amounts that we have. We then need to take these amounts and apply them to, in essence, the units completed and transferred out, the units still in work in process. The way we do that is we're going to have the calculation of the equivalent units. So then we took the equivalent units, we divided out the equivalent units here, the total equivalent units, and that gave us the 21 and the 15. Now we're going to take the units that we calculated last time. We'll start off with this 594 for the work in process at the end, and the 297, and then we'll go to the 5940 and the 5940 and apply them out using the cost per equivalent unit. So we're going to have the ending work in process equivalent units was the 594 units, and then the 297, this is the ending work in process amount. Then we have the cost per equivalent, which was the 21 and the 15 in dollars, units dollars. If we then multiply those two out, we get the 12,474 and the 4,455. And that adds up to the 16,929 total. Then we're going to have the units completed and transferred out. And we have these numbers in units. Our first calculation, 5940, 5940. We'll take that and multiply it by the cost per equivalent unit, the 21 and the 15, to give us the cost of units transferred out. Multiplying the 5940 times the 21 is the 124,740. The 5920 times 15, 89,100. The 124,740 plus the 89,100 gives us 213,840. So this is going to be the amount then that's going to be in the ending work in process for materials and conversion in terms of dollars now, and that's the total. Then this is the amount that was units completed and transfer out in dollars, materials conversion total. If we add those up, we get the 230,769, which should apply out to the total that we determined that we were going to calculate out. In other words, it ties out to our total costs. So we already had our total costs. Now we used those total costs. We used the cost per equivalent unit to apply out this total cost between the two segments of ending work in process, the costs that are still in the department, and the units completed and transferred out, or the costs that were transferred out. And then this, of course, will be our check figure, which should tie out to total costs. In this presentation, we will take a look at overhead costs. In a prior presentation, we looked at the cost flow of inventory, starting with the raw materials as it flows through to finished goods and is finally sold and recorded as an expense in the format of cost of goods sold. Within that process, within the recording of inventory, we note that there's three main parts. We have the direct materials, we've got the direct labor, and then the overhead. The overhead, we saw that was going to have the actual overhead that will accumulate upward, and then we're going to apply out the overhead to the department. So the idea of the overhead then is this area that we don't know which department to apply them to. Therefore, we put something into overhead, and then we apply it out to the appropriate location based on some type of estimate. In this presentation, we'll consider some of the items that would be increasing, or the actual costs of overhead, the overhead that would then increase, and we apply that overhead out based on an estimate. So note that the amount that we apply out will not match the actual overhead per se, and therefore this process will probably result in an under or over applied overhead amount that we'll have to process out, and we'll discuss how to do that in a future presentation. Here, we're concentrating on the actual manufacturing overhead. When considering the accounting for overhead, there's a few steps we want to keep in mind. The first is that we're going to set up a predetermined overhead rate. The predetermined overhead rate will typically be based on prior performance, or on the last time period, the last month, and then account for any adjustments in order to get the current predetermined overhead rate. We're going to use that rate to be able to apply the overhead out to the proper location, to the proper department. We'll actually do the predetermined overhead rate last, so we can see what kind of things would be in overhead, so that we can determine how we would then calculate the predetermined overhead rate. And then we're going to record actual overhead, so we'll actually enter the overhead, or the overhead that will be incurred throughout the month. This is not an estimate. We don't have to estimate what the actual overhead is. The reason we need to put it in the overhead and not to a particular process is because it's not because we don't know what the overhead amount is. We're going to have that actual amount, but we don't know which process to apply it to, and there might be some timing issues as well as to when we should apply them out. And then we're going to apply the estimated overhead to the process. So we're going to use some type of rate to apply out the estimated overhead to the proper process. So the actual overhead will typically differ from the estimated overhead. And again, part of that might be due to timing. In other words, we have it set up here, so we're going to have all the actual overhead calculated and then apply out the estimate. And that might not happen exactly in that order, which is the reason we need the estimate in the first place. We might use the estimate in the first place, and therefore we won't have an exact matchup between the actual overhead incurred and the estimated overhead. And then we're going to have adjust the over or under applied overhead. So at the end of this process, we could have overhead that was either under or over applied. we'll have to do something with that because we want to make sure that it's all applied out so we can go through this process again in the next time period. So what we're going to do is we're going to set up the predetermined overhead rate. The predetermined overhead rate will help us to apply the overhead to the appropriate department as we go through. We're going to record the actual overhead that we incur during the time period. We'll discuss here what those components will be. And then we're going to apply out, of course, to the proper department based on our predetermined overhead rate, which is an estimate. These two will not be the same, and therefore we'll have an over or under applied amount, and we'll have to adjust for that, and that'll be the final step. Here we'll be considering what kind of things are going to be included in overhead. So we could have in factory overhead anything that you see in a book problem that has factory in it. Mainly, if we can't apply it directly to the department, will typically be in overhead. So factory depreciation, for example, if it's for the full factory and we can't apply it out directly to the department, we're just going to dump it into overhead and then apply it to department using the predetermined overhead rate. And it might look something like this. We're going to debit the factory overhead and we're going to credit the accumulated depreciation. So note, this is very similar to a depreciation journal entry we would normally have. You might have just memorized this journal entry for depreciation, debit depreciation expense, and credit accumulated depreciation. Now this is going to be different because the depreciation is not expensed in that time period. It's being used to create inventory. That's why we're putting it into overhead, which will eventually go into the work in process and into inventory, which we will expense, but in the format of cost of goods sold, not in the format of depreciation. So this will then increase the overhead. So overhead will go up from 0 up in a debit to 50 with this debit up top. Accumulated depreciation, then credit balance, contra asset account was at 50, goes up by 50 to 100. There's the 100. Here's the equipment. It's going down in a book value method because the contra account is going up. And so that is the difference between those two would then be the book value. And then we've got the factory overhead now at our 50. Next item, factory utilities. So we might have utilities. Again, utilities, we've probably memorized a utilities journal entry to be utilities expense, debit, and credit cash or something like that. But in this case, it's utilities on the factory where we make inventory, and therefore we're not going to expense the utilities as utilities expense, but put it into the inventory in the form of factory overhead, which will then be part of finished goods inventory, which we will expense in the form of cost of goods sold eventually at the point of sale. And then the other side, we're going to put into accounts payable. We haven't yet paid it in this case. Accounts payable going up. Factory overhead then increasing by the 28,000 from 50 plus the 28 to the 78. Here it is here. So that's this 20,000 we're posting out to the GL. And then the 28 for the accounts payable increasing. It was at 965 by the 28 to 993. So there's going to be our 993 on the trial balance. You'll note that the bucket of factory overhead is pretty random. We got some random stuff here. So now we've got utilities, we had depreciation, and next item is going to be indirect materials. When we consider materials, note that a lot of the materials we take, we will know which department it goes to, and therefore we'll apply that out to the department. We'll apply it out to whatever work in process department it should go to, whether in this case it'd be A or B, but we would apply that out to the work in process. It's the indirect materials that we don't know where it should go, right? We don't know which department it should go to if it's indirect. So if it's indirect, small materials possibly, therefore we're going to dump that once again into factory overhead. So factory overhead then, debit increased by the 68, and the raw materials would increase by the raw materials would decrease by the 68. So we're decreasing the raw materials, putting it into the factory overhead. If we took a look at the GL accounts, then we have our factory overhead is going to go up by the 68 to 146. So here's our 146 now, and then the raw materials are going to go down from the 153.5 by the 68 to the 85.5. And so the 85.5 is here. We took it out of one inventory, put it into another, not directly into work in process. We couldn't put it there. We don't know which job or which process to go to, and therefore put it into factory overhead, which we will then apply out using some format of estimate. Labor is the same way. If we have labor and we know where it's going to go, we can then put it right to the work in process. If we know which department to put it to, we can debit work in process and credit the factory payroll. Note when we consider wages, we're typically thinking of processing payroll. We're thinking about kind of this is a payroll process. We're not getting into any kind of payroll taxes or that kind of complicated stuff, but just note that this would be on the most basic level to pay payroll. We would debit payroll expense normally and credit cash to pay payroll. That would be the most basic. There's a bunch of other things with holdings and whatnot, but that would be the normal journal entry. We here, instead of debiting the expense, once again, we're going to be putting it into the inventory. If we knew which department it should go to, we can put it directly into the work in process. That's going to be the direct labor. Indirect labor, what we're concentrating on here, means we don't know which department to put it into. We're paying people that might be working in both departments, and therefore we're going to put it into the factory overhead. So rather than expenses, no matter which way it goes, whether it be direct or indirect, we're not, it's kind of like running payroll. We're processing the payroll journal entry, but instead of expensing it at that point in time, we're capitalizing it at inventory in one way or the other, either in work in process or factory overhead. The other side being cash, or in this case, usually in these problems, they're going to put it into a payable account, because note what the payable account does. It allows us not to have a description and still know kind of what this journal entry is doing. If I just put cash down here, then I won't know really just by looking at the journal entry that what this was for. If I say it's a payable that we haven't paid yet, then even without a description, I could say, oh, well, that looks like it's went into overhead because it's indirect labor just by the accounts that are going to be affected here. So if we look at the GL then, we were at 146 for the factory overhead. It's going to go up by 790 to 936. So here's the 936 in factory overhead. Payroll was at 780,000. It went up by 790 to 1,570,000. So there's our payroll. There's our liability. So these are just a few items that can be in factory overhead. Notice that there could be a lot of different things in there, and typically it's going to be anything that's basically on the factory that, again, we couldn't apply to a particular process. Once we have this into the factory overhead, you can see we have this debit balance here. We want it eventually to go to work in process. So we're going to have to do that in some way. We'll do it with an estimate. The estimate won't use exactly this number. It's going to be based on estimates, basically on prior year estimates, with some kind of format for us to apply it out based on an estimate. And therefore, when we do apply it out, it's probably not going to be exact. And if it's not, we'll have an over or under applied amount, which we'll have to adjust out. So those are going to be the steps we need to do going forward with relation to the factory overhead. In this presentation, we'll take a look at the calculation of the predetermined overhead rate and then use that predetermined overhead rate to allocate the overhead to the processing departments. Last time we went over the process of overhead and what items could be included in overhead to calculate actual overhead. Let's do a quick recap before we get into the rate of overhead. The items that we need to consider when considering the overhead process will be that we need to set a predetermined overhead rate. And usually we do that based on the prior period. So we're going to take the prior period information. We'll set up the predetermined overhead rate. We're going to do that after we go through the actual overhead or what would be included in overhead to give us an idea of how that might be done. And then we're going to record the actual overhead during the period. And that's what we did in the prior presentation. We looked at those items that might be included in actual overhead. We want to apply the estimated overhead to the processes. So we're going to take the estimated overhead and apply it out to our processes involved, the production department. And then we're going to have the adjusted for the over or under applied overhead. In other words, we still might have a difference between the actual and estimated overhead, and we'll have to apply that out. Here, we're going to be concentrating on setting up the predetermined overhead rate and using it to apply out the overhead to the proper process, the proper department. So just recall from prior presentations the kind of things that would be included in overhead. We had factory depreciation that was increasing the overhead. Things like anything that's on the factory that we can't apply to the process. We had the utilities on the factory, for example, increasing the factory overhead. We had things indirect materials, which was increasing the factory overhead. We had indirect labor, which we increased the factory overhead. So notice the factory overhead can be comprised of many different things. When we think about estimating what the factory overhead predetermined rate should be, we're going to have the predetermined overhead rate. we're going to base it usually on the prior period. So we're going to consider the prior period and use the prior period number and possibly make adjustments to them to account for what we think might happen in the current period. And then we're going to make a predetermined overhead rate based on that. That will typically consist of an estimated overhead cost, again, possibly from the prior time period that we would then adjust for, look at, project out into the future, take the prior number for last month, project out into the future of what kind of changes might be in the following months, and come up with the estimated overhead cost, what we think the overhead cost will be at the end of the current time period. And then we're going to take that and divide it by an estimated activity base. Now, the activity base is going to be some type of thing that we're going to use to determine which process we're going to put something into. And notice with our departments, we said Department A was where we make the candy, possibly. Department B is a packaging department. We might consider, in that case, Department A to have more of the weight to it, meaning much more might be done there than in Department B. And therefore, you would think that we would want to allocate more costs to that department. So we might then want to determine something that would apply out more of the costs to an appropriate fashion, in an appropriate fashion. We're trying to look for something, an activity base, that could be used to apply out the costs most efficiently. Now, a lot of times in book problems, we might use like machine hours, or we might use labor hours as some type of driving factor, because you would think that if we're in a process that has more labor hours, then it would be the labor hours relatively larger the process, and therefore we can use kind of like a ratio to apply more out based on that activity base. Now, we could use labor as a typical one to use if we're using some type of process, however, that doesn't have a lot of labor, because it's a process that if it's all automated, then we might use something like machine hours or something like that might be a more appropriate for us to determine how big one process is versus another, and therefore how much of the overhead to apply to one process versus another. Notice what we're not doing here. We're not just taking, oh, there's two processes, let's just divide it by 2. We could do that, but it might not be the most appropriate way to do it, because they might be processes that are not equal in value, and therefore we would use some type of activity base to apply out the overhead properly to the 2 items. So we're going to say that our predetermined overhead is 1.6. We're going to say the calculation here is 1.6. How do we get that? Well, we said that the estimated overhead costs from the prior period divided by our activity base, which we're going to say is direct labor in our case. So we're going to divide those out, get our predetermined overhead rate of 1.6. And then if we use that, and then we can look at our work in process, Department A has 400,000 direct labor, and work in process Department B has 185 direct labor, because we can determine the direct labor and we know what that number is, and we're going to use that number then to apply out the overhead between Department A and Department B. So that would mean that Department A is going to have 640, because we're going to take then our 400,000 times 1.6, and that's going to be 640. And then Department B is going to be 185,000 times 1.6, and that's going to be the 296,000. And then we're going to take out of, then adding those two up, 640,000 plus 296,000, the 936,000 is what's going to come out of the factory overhead. So we're going to be, this is going to be our starting point. Then we had the factory overhead at the 936,000. We pulled money out of the factory overhead, which in this case happened to be perfect. It happened to work out perfectly. And we took 640 applied Department A and 296 to Department B, applied those out. This is our beginning number. This is our ending number. Factory overhead goes down to 0, and these two items are applied out. Now, in this case, it happened to work out perfectly, and that the factory overhead went down exactly to 0 as we applied this out. Because it's an estimate, it may not be the case where that always happens. And we may have an estimated number, and we may not apply this out perfectly at the end of the time period. If that happens, if it doesn't get applied out perfectly, then we'll have a remaining balance in the factory overhead account that we'll have to then account for. We'll have to then clear out in some way, shape, or form. So again, the calculation, what we would have here is we have the predetermined overhead rate. We have the estimated overhead costs, typically from the prior period. Estimated overhead costs, in this case, it was the same, right? Our estimated overhead costs were $936. And then we're going to divide it by the estimated activity base, which in our case was the 400,000 plus the 185,000 of the direct labor. And then we took that and divided it out. We get that 1.6. We're going to use that 1.6 then by determining what the direct labor per department is, something that would be given within the problem, something that would be given and something that we would have access to. And we're going to take those numbers and multiply it times the 1.6, which is the predetermined activity rate, to get our application or allocation of this 936 applied out to Department A and Department B. In this case, again, it works out perfectly to take this down to 0 exactly. If that doesn't happen, if this doesn't go down to 0 exactly, then you're going to have an over or under applied amount that will then adjust for by adjusting it out typically to cost of goods sold, so that we can then start this process over again. In this presentation, we will take a look at the adjustment for over or under applied overhead. First, let's take a look at the recap of the process of overhead. What goes through the process, or what steps we need to have through the processing and recording of overhead. First, we typically set up the predetermined overhead rate based on last year's information. We set up the predetermined overhead rate. We then record actual overhead. We know what the actual overhead is. We're going to record the overhead, but we probably don't know which department that it needs to go to. So we have the actual overhead, therefore not going into work in process, but to the departments. We then apply estimated overhead to specific processes, and this is going to be the estimate of us applying out the overhead to the processes. It is only an estimate, so therefore these two items will not match oftentimes. And note that in a perfect world, this would be in a linear situation. We would do this first, then this, and then this. If we had that kind of ordering, it may be possible for us to apply out the actual overhead. But in the case where there isn't perfect ordering, we have to use, of course, some type of estimate. That estimate means that the actual overhead will not be the same as the amount that will be applied out, and therefore we will have to deal with, in that case, what happens now where we have an under or over applied overhead, and we'll have to adjust for that. We're going to have some amount then, in other words, left in overhead, which is either under applied or over applied, which we'll now have to make 0 because we want to be able to start this process over without having anything in the overhead account. So in this case, in this example, you can see what actually happened. If you consider the factory overhead account, you're going to consider what side of it is the actual and what side of it is applied. Overhead is basically, we can think of it as an asset type account, or goes up with debits, or has a normal debit balance, and then it goes down with a credit. So in this case, the actual items, these items on the left, the debit, are going to be the increases in overhead. All the stuff that we had a cost for, but we didn't know where to apply it to, therefore put it into the factory overhead. Indirect labor, indirect materials, other, depreciation on the factory, utilities on the factory, anything on the factory that we couldn't apply out, those are the actual. And then this number must be what we applied out. That's what we took out. So you can see this happened in kind of linear fashion. It went up, 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 increasing the balance for all the activity. And then we applied out to the actual work in process account in this case. But the amount we applied out is not the same as the actual cost. Notice the actual was at 7,100, and the amount we applied out was less, 6,720. Therefore, we under applied. And notice if you see it in this format, you can kind of work it out in your head and say, what does it mean to be under or over applied? In a lot of test type questions, they may not give you all this detail, and they may just tell you it was under or applied or over applied. And what you want to do is write down a T account or something like this and actually kind of jot down the debits and the credits, and then think about what does it mean to be under applied or over applied. In this case, this is how much the actual was. This is how much was applied out. It's less than the actual, and therefore we underapplied. We applied less than the actual, and we're left with a debit balance because we're left with some of the actual that wasn't applied out because it was underapplied. Once we know that, once we know that we have a debit balance, then it's pretty easy to know what we need to do. We need to get rid of that debit balance, and usually if it's immaterial, we just take it to the cost of goods sold account, meaning we're just going to debit the cost of goods sold and credit this account just to make it go to zero. Why? Because the cost of goods sold is really where the end process will be, meaning after it goes through all of the inventory accounts, it'll clear out to cost of goods sold when it is sold. And what we want to do is have it go to a temporary account because it's immaterial. We don't want to see it again. We want it to go away. If we put it into another one of these inventory accounts or a permanent account, a balance sheet account, it won't go away once we clear out the closing process. But if we put it into the cost of goods sold, then it's through the closing process, this whatever's in net income at the end of the time period will roll in to retained earnings, and we won't see it anymore. So it'll kind of wash out in cost of goods sold. And because of course we're hoping it's small, it's immaterial, then it would be appropriate for us to do that and basically put it in the cost of goods sold, that being the easiest thing to do. So then it will then close out in the closing process, and we'll be okay to just start over in the next month. So that process, then we're going to say cost of goods sold is going to be increased, and then the other side is going to be taking down the factory overhead. So our cost of goods sold then goes up, and then the factory overhead is going to go down to zero. So now we're at zero. That's what we want, so that we can then start over from a fresh start in the next time period. Now note that the reverse could have happened here. It could quite well be that we over-applied. What if this number was bigger than this number? If this number was bigger than this number, then we would end up with a credit balance. Let's just say it was bigger by $1,000. We would end up with a credit balance in the factory overhead, which shouldn't happen because notice it's kind of a debit balance account. It's kind of like a clearing account in that it goes up and then it goes down to zero in the time period. So a temporary account or a clearing account, but it usually has a debit balance because it goes up and then we apply out. You would think if it was a perfect world, it would increase, and then we would apply out that increase. It shouldn't go negative. That would be funny. That means we applied out more, or in other words, we over applied. That would be the case where we over applied. Now, if we over applied, then all we would do is just say, okay, I know this has a credit balance, so I'm going to do whatever I need to do to make it go to zero to start over next time. And in this case, it would be the same journal entry, but we would have to debit the factory overhead by 1,000, in our example, 1,000, and credit 1,000 to the cost of goods sold, because we're going to do whatever we need to do to make this go down to zero. And this looks a little bit funny because normally cost of goods sold is an expense account, and it doesn't normally go down. So usually it only goes up. This is an exception to the rule typically being cost of goods sold only goes up. In this case, we're going to say it goes down. Why does it go down? Because it's immaterial, and we need to do this to correct for an estimate, basically. So because it's a small amount, because we know it's an estimate, because it's immaterial, we're gonna break the rule and say we're gonna decrease an expense account here and do what we need to do, whatever we need to do to make this small amount, this estimated amount, small in comparison to everything else. Hopefully that's going to be the idea, go down to zero. So we do whatever we need to do to get the factory overhead to zero, and typically the other side goes to the cost of goods sold. That's the easiest thing to do, and that's okay typically if it is immaterial to do so. Hello, in this lecture we're going to talk about a process cost system and equivalent units using the FIFO method. We will be able to, at the end of this, calculate equivalent units, use equivalent units to allocate material and conversion cost to departments, and create journal entry to transfer cost from one department to the next. All right, so this is the information that we will have here. We're going to be looking at focusing in on Department A. We're assuming there are two departments in a process cost system. So remember, when we're thinking about a process cost system, we're thinking about something that makes the same type of units, something like taffy or oil or something like that, that every unit is the same, and therefore we're going to allocate the cost of the production using a process cost system allocating the costs to a particular process. In this case, we're going to have the process A and process B, department A and department B, and follow the costs through that flow in this way. All right, so we have the information in terms of units over here. We have the information in terms of costs. This is typical information that would generally be given within a problem of this kind when we're calculating the equivalent units. We have the materials and the conversion that we're talking about. Now, materials is pretty straightforward. It's the materials, the raw materials that are going into it. The conversion is going to be the direct labor and overhead, the things that are going to convert the materials to the end product. So we got to break those things out, think about equivalent units in terms of materials and conversion. Our goal here is to use those equivalent units to help us to allocate these costs to the proper area, the proper department, proper function, and that's what we will be doing at this time. So note what we have here in dollars. We actually kind of know the dollars here. Our goal here is to take these and then allocate the dollars to the proper department using kind of a ratio analysis. That's what the equivalent units will help us to do. All right, so here we have our information down here. Working through the problem, we're going to start with beginning working process in units. That's going to be given in the problem. So we have 3,000. We would know it in real life because that's where we ended last time. So that's where we're going to start this time. This is units, not dollars. So you want to keep these two separated as we go. In this case, we're talking, of course, units, not dollars. And then we're going to have the units started and completed. So units started and completed here. We want to break this out. This is a bit unusual, a bit new to break this out. The reason we're breaking this out is because under any method, under first in, first out, or any method, if it's started and completed, we'll know how much has been allocated to those units because everything has been allocated to those units. They were both started and completed, as opposed to the units that were in there at the beginning. It's hard, we have to think about, well, how much of the conversion has been done and how much hasn't been done. The units that we can specifically say these were started and completed will, then we can allocate all of the information or the costs to them. So we're going to back into this number. Now they're going to give us the total units to account for, 24600, minus the units that were in there at the beginning, because if they were in there at the beginning, we did not start them and complete them, so minus 3,000. And then we're going to also subtract out the units that are still in there at the end, because if units are still in there at the end, then we did not start them and complete them. That's going to be the 2400. That gives us our 19.2. So this is the number we're going to back in to. And then we've got the ending work in process. We got the 2,400. We would be given that in a problem. We would know that in real life because we would kind of be able to count what's still left. And then we have the total units. So note the total units are counted for as the 3,000 plus the 19.2 plus the 2,004, and that gives us the 24.6. But note what we really had to figure out here was actually this number. So if you put all these in there, you would know this, you would know this, you would know this, backing into this number. That's the kind of unusual calculation we need to put in place so that we can allocate our equivalent units in a first in, first out method. So now what we're going to do is we're going to take, this is the total units we need to account for. They're not completely done, all of them, in terms of the materials and in terms of the conversion. So these are the units that are kind of half done, or, you know, we're thinking of them as being partially done. The materials for the units for materials, the units for conversion, both those equivalent units will be less than this number. So we're going to take this number, think about the materials, those same units in terms of materials, then think about this same number in terms of conversion. We're going to break it out line by line. So starting with the beginning units here, if the units were already in there as of the beginning, say if we're like making some kind of bread or something like that and the dough was already in there, that's the first thing that goes in there. We're not putting any more dough in there. It was already in there. We just need to convert it or finish converting it to the ending product. So here there's 0 in terms of materials, because nothing's going to go in this time period because it was all in there last month, and therefore we have 0. On the conversion side, we're going to have to say, okay, how done is this dough in this case in terms of going to bread? And last time they're going to have to give us a number. We're going to have to make an estimate as of the end of the period last time, which was 40% complete as of the end of last month. Therefore, this month, 100% minus 40% is 60% that we need to complete. So we're going to take these 3,000 units times 60% for conversion, in terms of labor and overhead, the stuff to convert the raw materials to the finished goods, 1,800 units. Okay, so 3,000 is 0 for materials and 1,800 for the conversion in equivalent units. Next, we have the started and completed. This one's going to be really easy. That's why we broke it out. If we started it and completed it, then all the stuff in terms of materials like dough and whatnot, or flour and stuff, went into the process this month. So 100% same equivalent units for materials, 19,002. Same for the conversion. If we started it and completed it, all the direct labor and overhead went in this month. Therefore, we have the same 19,002 in terms of equivalent units for conversion. So total units is the same as equivalent units for material and the equivalent units for conversion because we started them and completed them this time period. Then we have the ending work in process. Ending work in process. Now, if it's still in the work in process at the end, we're assuming that we started it, we put the materials in this time, and we didn't finish it. If the materials were in there at the beginning, we of course would have finished that round of stuff and then put more stuff in there. That's the assumption under a FIFO first in first out method. Therefore, if it's still in there at the end, 100% of the materials have been input. Therefore, we have the 2004 in there for materials. It's the conversion that hasn't yet been done, the direct labor and the overhead. So in terms of direct labor and overhead, they're going to have to give us a number. In real life, we would have to give some kind of estimate and say, okay, how done are they? We're saying 80% done. Therefore, in terms of direct labor and overhead conversion, we're going to take that 2004 times the 80% and come out to the 1,920. So now we can add up our totals here. So we're going to say this is the total units to account for, whether they're done or not. These are the equivalent units in terms of materials, and this 24,600 compared to the equivalent units in terms of conversion. Of course, adding up this column here and adding up this column here. All right, so now let's put these numbers to use. Next thing we're going to do is we're going to say, all right, well, we've got our equivalent units here. We're going to compare that to the costs and come up with a cost per equivalent unit. So we're going to just, this is a pretty easy calculation. Once we have these numbers, we're just going to take the cost incurred for the period. And notice it's important to take the right number here. We're taking the costs during the month, right? So that's going to be the 248.4, not the total here, because we're not taking into account the beginning information that was accounted for last month. So we've got the 248.4, and we're going to divide that by the equivalent units for materials, which of course is this number that we just calculated. This is a dollar amount, this is a unit amount, and that gives us the dollar amount of $11.50 per equivalent unit in terms of materials. We're going to do the same thing for conversion. So we had the conversion costs up here, conversion costs coming from there, and that's dollar amount divided by the units gives us the cost per unit in terms of conversion, which is going to be labor and the overhead. So now we got our equivalent units. Now we can take these and apply them out to the process. So we know how much stuff is still in Department A in terms of units and in terms of dollars that are allocated those units, as well as in Department B, or what was transferred out of Department A. All right, so let's do this. We have our information on this side that we've done so far. It's a little small, but it's there. And then we're going to have our calculation. So here's our beginning inventory. That's what was in there at the beginning. That's what was in there at the beginning. Then we're going to add to that, we're going to calculate the cost to complete the beginning inventory. So that's what you're going to do is we're going to go through this one kind of line by line and convert our equivalent units line by line to dollar amounts using our equivalent unit costs here. So we've got the beginning costs. We're going to say the direct materials was 0. So that's this number here. Direct materials is 0. And times, of course, the 1150 here gives us, of course, 0. And then we're going to take the conversion in terms of this beginning line was this 1008. 1008 times the conversion cost per unit, the 47.25, gives us the 85.50. And if we then add those up, we got the total cost completed in the beginning inventory. And then we're going to add up these two, the outer column, the beginning inventory plus the total cost of completed. And that gives us the total cost of units in the beginning inventory. So everything that was in there prior month costs and what's in there at this point in time is these two numbers there. Then we're going to go to the next line item. We're basically going down, okay, now we're on the stuff that was started and completed. And we're going to say, okay, well, there's 19.2 in terms of units times our cost per unit, the 1150. That gives us the 22800. Same thing for conversion. So conversion, we're taking this number, 19.2, times the cost per unit, 47.25, means we have a total cost of the 907,200. And if we add those up, we got the total cost of units started and completed, 1,128,000. And then if we add up this number and this number, we're going to get the total cost units transferred out. So we added this and this to get to this number, then we're adding this and this to get to this number. This is what's been transferred out, because remember, the beginning inventory under the FIFO method, if it was still in there at the beginning, we finished it and transferred out. That's the assumption. And if it was started and completed, we finished it and transferred it out. So in terms of the dollar amount now, we've applied the dollar amount to the units. This is the dollar amount of the journal entry that's going to be there, that's going to take it out of the work in process for A and transfer it to the next process, the work in process for B, which if we were making bread or something, will probably be like the packaging department from, you know, the production of the bread department. All right, but we're not quite done yet, because we haven't done the ending work in process. That's the stuff that's still left in the process, the stuff that's still not quite done in A. And here we have the 2004, so here's the 2004 times the cost per unit, the 1150, gives us the 27.6. And we have the conversion 1920 times the 47.25 cost per unit of conversion gives us the 90,720, and that adds up to a total cost of ending work in process, 118,320. And then if we add up these outer columns here plus the 118,320, that gives us the 1,452,240. The reason we want to calculate that is because that should tie out to our total cost number here that we started with. So we started with our total cost number. Remember what our goal was to take this allocation and allocate it between the departments. Departments A, which is kind of the making of the bread in this case, and Department B, which is going to be the processing, or the stuff that's going to transfer to Department B, or like packaging or something like that. So remember, this will be the actual journal entry then to take the stuff out, and that will leave us with ending inventory here. Let's see what that looks like in terms of a journal entry. So here's our same information. So then we're going to take a look at this journal entry. We've got the work in process for A, we got the work in process for B, we have the 1,452,240 in Department A. The journal entry here will be the credit to Department A of the 1,333,920. That, remember, came from our worksheet here. So there it is there. We're going to take that out of Department A. That's the stuff that we have then completed. And it's going to transfer to Department B. So it's going to go into Department B. And now Department B is going up by that amount. So that would be the flow of the transaction, the journal entry to take it out, and the allocation method. Here it is if we pull in all the other accounts. Of course, what we are basically doing is taking it out of one asset account, being the inventory account, moving it to the next asset account, the next inventory account. It will then go to the finished goods, and then we will have the cost of goods sold finally once it is then sold at the end of the day. That's when we're going to actually expense all these costs that we are talking about at this time.